Wake up. Your 1-500 offshore leverage is slashed to 1-30. VPN access is blocked. Your favorite prop firm has overhauled its internal rules. This is the reality of trading in 2026. For years, retail traders utilized a dual reality. Offshore jurisdictions provided a haven for those seeking 1-500 leverage, allowing small accounts to control massive positions through regulatory arbitrage. That gap is closing. Major bodies like ESMA and ASIC have enforced global harmonization, stripping away the legal loopholes that previously allowed offshore brokers to offer flexible safety rules. This shift targets the VPN workaround. Brokers are now legally accountable. They trace the source of funds and banking data linked to accounts. If your financial footprint leads back, they must restrict your leverage, regardless of your reported IP address. Relying on massive leverage to offset a small account balance is no longer a viable strategy. To survive, you must tear down your current approach and rebuild it for a market that prioritizes precision over raw multiples. This diagram shows the capital required to control one standard lot of the euro to US dollar pair. Under the old 1-500 model, you could control this position with minimal cash. The 1-30 global standard requires significantly more margin to hold the exact same position. This math forces you to abandon leverage-dependent strategies. Success now requires a capital-efficient model focused on compounding smaller, well-managed positions rather than swinging for the fences with over-leveraged entries. Prop firms are seeing a similar restructuring. For years, these companies operated in a gray area, marketing themselves as educational services to bypass financial licensing. New mandates require these firms to register as regulated investment firms. They must prove they are hedging trades in the real market and have the capital reserves to pay out successful traders. Because they are now regulated, your payouts are reported directly to tax authorities. While the old no-limit challenges will vanish, these mandates protect you. They ensure the firm you trade with isn't operating a Ponzi-style model that could disappear with your hard-earned payouts. If you've ever felt like a broker feed hunted your stop-loss, you've experienced the opacity of the B-book. Historically, brokers used toxic flow filters to identify traders using latency arbitrage or predatory algorithms, often without explanation. New rules change that. This chart shows the mandatory AI risk management disclosures now required for B-book brokers. They must be transparent about their internal algorithms, displaying the exact decision pathway of when a trade is offset to the market versus kept internal. If your strategy is flagged as toxic and your execution speeds are throttled, the broker must now provide a clear technical reason for that restriction. This transparency turns an adversarial relationship into a collaborative one. You can now choose electronic communication network environments that align with your trading style, ensuring your orders are filled with minimal slippage. One technical change often overlooked is the global shift to T+1 settlement. While it began in equities, the interconnected nature of finance has forced the FX market to accelerate its settlement cycles. This shift impacts the tomorrow-next market. This graphic shows the traditional T+2 settlement window compressing into a T+1 block. This shorter window for swaps leads to sharp spikes in overnight funding volatility. The Bank for International Settlements warns that this acceleration leads directly to increased volatility in those overnight rates. For swing traders, your cost of carry will fluctuate more than in previous years. A position that cost $5 a day to hold might spike to $12 during high volatility settlement windows, especially during Wednesday triple swaps. Swaps are no longer a static background fee. You must factor settlement volatility into your daily risk-reward calculations. Opening an account also requires a higher security standard. The rise of AI-driven deepfakes has rendered traditional identity verification, like utility bill photos, obsolete. The 2026 standard is blockchain-based identity verification. Using decentralized identifiers, brokers now verify your identity via encrypted protocols. This creates a unique, cryptographic digital fingerprint linked to a secure ledger. This digital footprint secures your capital from account takeovers, as any withdrawal must be signed by your unique ID. Over time, this profile builds a trader score, proving your experience and helping you unlock higher quality liquidity from top-tier brokers. The 2026 landscape marks the end of the reckless retail era, but it shouldn't be feared. These changes filter out bad actors and reward traders who prioritize discipline and technical proficiency. The professionalization of the retail space means better execution and higher security for your capital. It is time to move past high-risk gambling habits and become a systems architect of your own trades. Audit your current brokerage and prop firm exposure against these new standards. To find partners who are already moving toward these mandates, use the tools at FXNX to navigate this secure, transparent landscape.